Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing today? Hope you're having a good day out there. Hey, we got to go over this again. This one gets confused a lot. I have customers get confused by this all the time. I'm going to help you guys out with this one here today. What we're talking about is the deduction that you get by contributing to your traditional IRA. It's widely known that if you contribute to a traditional IRA, whatever you contribute is tax deductible. Essentially, you're getting repaid for the taxes on the money that you put in. The way this works is you have dollars that go from your bank account to your traditional IRA, and those dollars you already paid tax on because they're in your bank account, which means they came from your paycheck to your bank account. It's already been taxed. So when you contribute to a traditional IRA, at the beginning of the next year, you get a form basically that says you contributed $6,000 to your traditional IRA. You file that with your tax returns and you get reimbursed for the tax that you paid on that dollar. So essentially it makes it pre-tax money again, whereas it wasn't in the first place. However, there's some fine print, and the fine print always trips people up. So I want to cover this here with you today because it depends on if you have a 401k at work or if you're married filing jointly. Does your spouse have a 401k at work? If so, then there's an income limit. Now, first of all, I want to say that this is not a eligibility limit. You are always eligible to contribute to a traditional IRA, no matter how much money that you make. A Roth IRA, that has income limits, which may disqualify you from contributing to a Roth. A traditional IRA, you can make $1 million a year. If you want to put money in there, you can. You just may not get the deduction for doing so. Okay, so by the way, this applies to traditional IRAs, also SEP IRAs and simple IRAs. All of this counts, right? So when I reference a 401k, I'm also referencing a SEP or a simple, and then stick around to the end because I'm going to actually show you how to figure out your modified adjusted gross income, because that's what we're really talking about in terms of how much you can contribute. All right, let's go over the screen here. Okay, first of all, if neither you or your spouse have a 401k or are offered a 401k at work, then you can contribute the full amount and that's fine. You'll get the deduction, no big deal. Now, if I'm going to pretend that you're married and it's you that has the 401k, right? I've done videos on this in the past, but we're going to just revisit this again. Let's say that it's you have the 401k, your spouse does not, you're contributing to a traditional IRA, or you want to contribute to your spouse's IRA. The way it works in 2020 is $124,000 modified adjusted gross income. If you make more than that, your modified adjusted gross income, I'll cover that for you here in just a second, then you actually will get no deduction no matter how much you put in an IRA. The number actually goes from 104 to 124,000. This bracket here, or this gap, means if you make 105, 107, 110, whatever it is, you are phased out of the deduction. So you contribute the $6,000 to your IRA, you may only get some deduction. It's linear across the curve there to figure out how much you get, basically. All right, if you're single and you have a 401k, you're not married filing jointly, and you make over $75,000 modified adjusted gross income, then you cannot contribute. So this bucket here, you can contribute, you don't get the deduction. Got to be clear on that one there. So over $124,000 married filing jointly, over $75,000 if you are single, then you are phased out. You will not get a deduction. Your magic number is 65 to 75. So anywhere in that area there, then you are phased out of getting a deduction. You'll get some reduced deduction is basically how that works there, right? Okay, cool. All right, so if you have the 401k and you're contributing to a traditional IRA, next step is to reference your filing status and also reference your modified adjusted gross income. Now, if your spouse has the 401k, right? So we're going to assume that you are the, let's say husband and wife. You're the husband, you got a traditional IRA, your spouse has a 401k, a SEP IRA, or a simple IRA. Remember, those all count in there with the mix there. Then your magic number is 206 for 2020. If you have modified adjusted gross income together as a family, over that, then you are phased out. It goes from 196 to 206. So this is your area here. If you make somewhere in between there, you'll get a reduced deduction, but anything over $206,000, you are officially phased out. So keep that in mind. This is if it's you that has the 401k. This is if it's the spouse. I can't tell you how many people that I find that all of a sudden they've been contributing all these years and they didn't get the deduction. They didn't know. What's the importance of that? Well, it means that in your traditional IRA, you have post-tax dollars. Why? Why would you have post-tax dollars in your IRA? If you don't know any better, nobody's going to tell you. You're going to get all the way to retirement, withdraw money, then you're going to report that, or your brokerage firm is going to report that, and you're going to owe tax on that money. It's up to you to keep track of what's post-tax dollars and what's pre-tax dollars. So we want to make sure, as much as possible, we want to make sure that your traditional IRA stays all pre-tax dollars. If you're not eligible for the contribution, then by all means, use a Roth or do a backdoor Roth or convert the money, something like that. It takes an extra step there. Now, this is all based on your modified adjusted gross income. I'm going to actually put the link in the description below. This is from the IRS. It's really simple here to figure out what your modified adjusted gross income is. You're going to take your adjusted gross income. That's the easy one. We all know that. You see that on TurboTax or whatever you're using to file your tax return. It's the easy number. It's the bottom line number. And then you're going to add back student loans. You're going to add back tuitions and fees. These are less likely to be something you have to do, but foreign income, foreign housing, income from savings bonds, and any excluded employer-provided adoption benefits. Again, the further you go, the less likely it's supposed to apply to you. Now, what you're then going to do is take all those numbers and add them up. So likely most of you are going to put your AGI, add some dough back for the student loan interest, maybe tuition and fees if that was applicable to you in the year. You're going to take those numbers, add them up, put them on line number 8. That is your modified adjusted gross income. And so what that means is back over here, that's that number, that 124. When you add those numbers real quickly, rough it, rough ball in your head. If you end up with those numbers, you are not eligible for either some or all of the contribution that you make to your traditional IRA. And remember, that includes if you have the SEP IRA or you have the simple IRA and you don't have a 401k, these rules still apply. If your spouse has the 401k, SEP, or simple IRA, those rules still apply. So hopefully that helps you. Again, I'll put the link in the description for modified adjusted gross income. It's not complicated, but does trip some people up. So you'll check that out. And if you need help or you find that you're in this position, work with your financial advisor, work with the company that you're at, whatever you're doing, and if they won't help you, of course, this is marketing here, so keep us in mind at Jazz Wealth. You have a great rest of your day. Thank you so much for watching.